In April 2016, a hard drive left an anonymous law firm in Panama City. It contained 11.5 million documents, financial records, emails, incorporation papers, internal memoranda. The largest data leak in journalistic history passed to a German newspaper and then to a global network of 400 journalists working across 80 countries simultaneously. The world called it the Panama Papers, and for a few weeks in the spring of 2016, it felt like something was going to change. The documents implicated 12 current and former heads of state, 143 politicians and public officials, the wealth managers, lawyers, and advisors of countless billionaires, celebrities, and corporations across more than 200 countries. The Prime Minister of Iceland resigned within days. The Prime Minister of Pakistan was eventually removed from office. Banks were fined. Investigations were opened. Hearings were convened in parliaments across Europe, Asia, and Latin America. And then, largely, nothing changed. Because the structures revealed in the Panama Papers, the shell companies, the nominee directors, the layered jurisdictions, the trust arrangements, the holding company chains were not illegal. They were not the product of rogue actors operating outside the system. They were, and remain, a designed feature of the global financial architecture. Legal mechanisms, built by lawyers, registered by governments, serviced by major financial institutions, and used by people whose names appear in Forbes and on party donor lists and in corporate annual reports. What the Panama Papers exposed was not crime. It was a system, and understanding that system, how it works, who built it, who maintains it, and what it costs the rest of us, is what this video is about. What a shell company actually is. Start with the basics, because the terminology is designed to be impenetrable and there is no reason it has to be. A shell company is a legal entity, a corporation, a limited liability company, a trust, a foundation that exists on paper but conducts no actual business of its own. It does not have employees. It does not produce goods or services. It holds assets, or serves as a conduit for financial transactions, while the identity of the person who ultimately owns or controls those assets is hidden behind the entity's legal name. On its own, a shell company is not a crime. Not even close. Shell companies and similar structures serve entirely legitimate purposes that are recognized and permitted in virtually every legal system in the world. Estate planning, liability separation between business units, international business structuring, privacy in commercial transactions where competitive sensitivity is a genuine concern. The tool itself is neutral. The problem is not the tool. The problem is the system of tools deployed in sequence across multiple jurisdictions that creates what lawyers and financial regulators call beneficial ownership opacity, the condition in which no single authority, looking at any single layer of the structure, can identify the human being who ultimately owns or controls the underlying assets. Here is a concrete example of how the structure works in practice. A businessman in country A, call him the beneficial owner. The real person whose money this is instructs a law firm to create a trust in country B. The trust is the legal owner of a holding company incorporated in country C. That holding company is the registered owner of a property in country D and a bank account in country E. The trust in country B is administered by a professional trustee, a law firm, or corporate services provider whose name appears on the paperwork. The holding company in country C has a nominee director, a professional placeholder, who signs documents on instruction but has no real authority and no real knowledge of the business. The bank in country E sees only the holding company as its customer. No single entity in that chain, the trustee, the nominee director, the bank, the property registry, can see the whole structure. Each sees only its own layer. The beneficial owner at the top is invisible to all of them. And critically, he is invisible to the tax authority in country A that would like to know what he owns. This structure is not hypothetical. It is not the innovation of particularly creative criminals. It is the standard operating architecture of international private wealth management, offered as a service by major law firms, accounting firms, and bank wealth management divisions in every financial center in the world. You can find it described, without embarrassment, in the marketing materials of legitimate financial services providers. The Panama Papers did not reveal a secret. They revealed a scale. The secret, such as it was, had been sitting in plain sight in law firm brochures for decades. The jurisdictions that enable it. The global offshore system is not one place. It is a network of jurisdictions, each offering a particular combination of services, each competing with the others to attract capital registration and the fees that come with it. Understanding the network requires knowing the key nodes. The British Virgin Islands. The British Virgin Islands is home to approximately 30,000 people. It is also home to nearly 500,000 registered companies. That ratio, roughly 16 companies per resident, tells you everything you need to know about what the economy of the BVI actually is. The BVI became the jurisdiction of choice for offshore incorporation in the 1980s and 1990s because of a combination of factors. English common law tradition, which made legal structures familiar and enforceable to Western lawyers. Minimal disclosure requirements for company ownership, low incorporation fees, and a political relationship with the United Kingdom that provided a degree of stability and legitimacy that smaller independent jurisdictions could not offer. Today, BVI companies appear in a significant proportion of major international financial transactions. When you see a cross-border real estate deal, an international joint venture, or an investment fund, there is a meaningful probability that a BVI entity is somewhere in the ownership chain. This is not because the BVI has a particularly sophisticated economy. It is because the BVI has a particularly well-designed legal infrastructure for not asking questions. The Cayman Islands. The Cayman Islands has taken a different but equally lucrative position in the offshore architecture. While the BVI specializes in companies, the Cayman Islands specializes in funds. The vast majority of the world's offshore hedge funds, private equity funds, and alternative investment vehicles are registered in the Cayman Islands. This matters because funds are where institutional money moves. When a university endowment, a pension fund, or a sovereign wealth fund invests in a private equity fund, that fund is almost certainly a Cayman Islands limited partnership. The Cayman Islands sits at the junction between the legitimate institutional investment world and the offshore architecture, which is precisely what makes it so important and so difficult to challenge without disrupting structures that serve genuinely legitimate purposes. Delaware, the American offshore. The detail that consistently surprises people who are new to this subject is this. The largest enabler of global financial opacity is, in part, American. Delaware has registered over 1.5 million companies. More than 65% of Fortune 500 companies are incorporated there. The reasons are partly about corporate law. Delaware's Court of Chancery is the most sophisticated corporate legal venue in the world, and its precedents give companies and their lawyers predictability that other states cannot match. But the reasons are also about disclosure. Until relatively recently, Delaware required no disclosure of beneficial ownership at the time of incorporation. You could form a Delaware LLC with a registered agent, a filing fee, and no requirement to name a single human being who owned or controlled the entity. Wyoming and Nevada have offered similar structures, with additional features that specifically appeal to asset protection strategies. In Nevada, there is no state income tax and no information sharing agreement with the IRS. In Wyoming, charging order protection, which limits the ability of creditors to access assets held in an LLC, is unusually strong. These are not accidents. They are legislative choices made by states competing for incorporation fees. The 2021 Corporate Transparency Act was a genuine step forward. For the first time, it required most U.S. companies to report their beneficial owners to FinCEN, the Financial Crimes Enforcement Network, within the Treasury Department. Companies with fewer than 20 employees and less than $5 million in revenue are covered. Large companies are exempt, which is a significant carve-out, since large companies have the most sophisticated structures, but the registry is not public. Law enforcement can access it. Financial institutions can access it under certain circumstances. Journalists, civil society organizations, and ordinary citizens cannot. Compare this to the UK, which maintains a public beneficial ownership register, or to Denmark, which publishes beneficial ownership data openly online. The American reform moved the dial. It did not move it to where comparable democracies have already arrived. What moves through these structures' shell company networks move three distinct categories of value. Understanding the distinctions between them matters because the policy responses are different and the moral weight is different, even when the financial mechanism is identical. Category 1. Legitimate tax optimization. The first category is legal tax planning by corporations and wealthy individuals. This is the category that occupies the largest volume of offshore financial infrastructure, and it is the category that the financial services industry most vigorously defends as legitimate. A multinational corporation assigns intellectual property rights, a patent, a trademark, a software platform to a subsidiary in a low-tax jurisdiction. Other subsidiaries in higher tax countries then pay royalties to that subsidiary for the use of the IP. The royalty payments reduce taxable profit in the high-tax countries and accumulate profit in the low-tax country. The arrangement is called profit shifting. It is legal. It costs the governments of high-tax countries, countries with functioning public services, infrastructure, and social safety nets, hundreds of billions of dollars in tax revenue annually. Apple, Google, and dozens of other major technology companies built versions of this structure around Ireland and the Netherlands in the 2000s and 2010s. The European Commission has repeatedly challenged these arrangements as illegal state aid. The companies and the Irish and Dutch governments have repeatedly contested that characterization. The cases have moved through courts for years. For individuals, the equivalent is the use of trusts, holding companies, and offshore accounts to accumulate investment returns in jurisdictions with low or zero capital gains tax, zero inheritance tax, and no requirement to report the assets to the home country tax authority. The arrangements are complex, expensive to maintain, and available only to those with substantial assets and the advisors to structure them. That is part of the design. Category 2. Wealth protection in volatile environments. The second category is more sympathetic, and it complicates the simple narrative of offshore finance as purely predatory. Across large parts of the world, across much of Africa, Latin America, the former Soviet states, Southeast Asia, and the Middle East, political instability, government corruption, and arbitrary asset seizure are not theoretical risks. They are lived realities. An entrepreneur in a country where the government routinely confiscates business assets from political opponents has a rational reason to hold wealth in a jurisdiction where confiscation is not legally possible. A professional, in a country with a weak banking system, has a rational reason to hold savings in a currency and institution that will not collapse with the next political crisis. This capital is not necessarily illicitly earned. It may represent entirely legitimate business success or professional income, and the desire to protect it from government overreach is not morally equivalent to evading taxes in a functioning democracy with legitimate public services. The offshore system does not make these distinctions. It provides the same anonymity and the same structure regardless of why the money is there, which means the same infrastructure that protects a legitimate business person in a corrupt state also protects a kleptocrat from that same state who is hiding stolen public money from the same population they have defrauded. Category 3. Illicit finance. The third category is the one the Panama Papers made viscerally real. Proceeds of corruption, bribery, tax evasion, sanctions evasion, organized crime, and human trafficking, laundered through the same legal infrastructure used by the first two categories. The Financial Action Task Force, the intergovernmental body that sets global standards for anti-money laundering, estimates that money laundering flows amount to between 2 and 5% of global GDP annually. At current global GDP levels, that is between $1,800 billion and $4,500 billion every year. The mechanism is not complicated. A Russian oligarch receives a bribe from a state contract. The funds are transferred to a BVI company owned by a Seychelles trust. The trust purchases a London apartment through an English company. The apartment is rented at market rates through a legitimate letting agency. The rental income is clean money. The asset is clean. The oligarch's family lives in it when they visit London. The original bribe is now a property. Multiply that transaction by the hundreds of thousands of times it occurs annually, across dozens of source countries and dozens of destination jurisdictions, and you begin to understand why global financial integrity estimates that developing countries lose between $1 trillion and $1.6 trillion annually to illicit financial flows. That is money leaving countries that desperately need it for schools, hospitals, and infrastructure, flowing through legal structures in stable jurisdictions, ending as assets in the portfolios of the people who stole it. The London property market deserves particular attention as a case study in what this looks like in practice. A 2022 report by Transparency International found that property worth at least £1.5 billion in the UK had been purchased by Russians accused of corruption or links to the Kremlin. The vast majority of these purchases were made through anonymous companies. When Russia invaded Ukraine in February 2022, and the UK government announced sanctions against Russian oligarchs, it discovered that it could not easily identify which properties were owned by sanctioned individuals, because the ownership was behind layers of anonymous companies in multiple jurisdictions. The Sanctions and Anti-Money Laundering Act had been passed in 2018. A public register of overseas entities owning UK property was finally launched in 2022, just weeks after the invasion made the gap politically impossible to ignore. 4 years of delay, during which billions continued to flow through anonymous structures into the London property market, in a system whose opacity was entirely legal. The professionals who make it work. The offshore architecture does not maintain itself. It requires an enormous professional infrastructure of legal, accounting, and financial services providers, whose legitimate business is building, maintaining, and defending these structures. The actors are familiar: major international law firms, with offices in every relevant jurisdiction. The Big Four accounting firms, Deloitte, PricewaterhouseCoopers, KPMG, and Ernst & Young, all have significant tax structuring practices that design and implement the arrangements we have been describing. International banks with private banking divisions, corporate service providers, firms that exist specifically to provide nominee directors, registered office addresses, and administrative services for shell companies, trust companies, registered agents. These professionals operate entirely within the law. Many of them are regulated, many of them have significant compliance obligations, and many of them are paid extremely well for the knowledge of where the legal line is drawn and how close to it their structures can operate. The financial services industry's role in enabling this system has come under increasing scrutiny. In 2012, a U.S. Senate investigation found that HSBC had processed hundreds of millions of dollars for Mexican drug cartels through accounts that its compliance systems had failed to flag. The bank paid a $1.9 billion fine, roughly 5 weeks of profit at the time, and entered into a deferred prosecution agreement. No individual went to prison. In 2017, the Danish bank Danske Bank was found to have processed approximately 200 billion euros in suspicious transactions through its Estonian branch, much of it from Russia and other former Soviet states. The scandal eventually led to the resignation of the CEO and criminal investigations in multiple countries. The question of individual criminal accountability for enabling financial flows of that scale through legal structures designed for that purpose has not been definitively resolved. The pattern across these cases is consistent. Large financial institutions process suspicious flows at scale. The flows are facilitated by structures that are individually legal. When the institution is caught, it pays a fine, calibrated to be large enough to look serious, but small enough not to be existential. Individual executives are rarely prosecuted. The underlying structures remain available for the next client. The reform gap. Every major economy in the world has, at some point in the past decade, announced its commitment to financial transparency. Beneficial ownership registers, information sharing agreements, anti-money laundering frameworks. The G7 has committed to them. The G20 has committed to them. The FATF publishes standards for them, and the gap between the commitments and the reality remains significant. The reform challenge has several distinct dimensions. The self-hosting problem. The most fundamental problem is that the same governments pursuing financial transparency are hosting some of the most opaque financial jurisdictions on earth. The United Kingdom's commitment to beneficial ownership transparency does not extend to the British Virgin Islands, the Cayman Islands, Jersey, Guernsey, or the Isle of Man British Crown dependencies, and overseas territories, whose financial services industries generate revenue that flows, in complex ways, back through the British financial system. The UK passed legislation in 2018 requiring its overseas territories to implement public beneficial ownership registers by 2020. That deadline passed without compliance from most of the territories. A revised deadline was set. That too passed. The territories have consistently argued that public registers would damage their financial services industries, and that private registers accessible to law enforcement are sufficient. The UK government has been reluctant to use the constitutional powers it has to compel compliance. The adaptation problem. The financial services industry is extraordinarily good at regulatory arbitrage, the practice of adapting structures to remain just outside the perimeter of new regulations while achieving the same practical outcome they were designed to achieve. When the OECD's Common Reporting Standard required automatic exchange of financial account information between countries, the industry developed new structures that moved assets from account formats covered by the standard to formats that were not. When the EU's anti-money laundering directives tightened beneficial ownership requirements for companies, advisors began using foundations, a different legal vehicle that the directives treated differently. When one offshore jurisdiction became too scrutinized, incorporation moved to the next one on the list. The regulatory perimeter is always, structurally, behind the architecture of avoidance. The rules are written after the structures exist. The structures adapt before the next set of rules is written. The gap is not a failure of regulatory design in individual cases. It is a systemic feature of trying to regulate a global, highly sophisticated, and immensely resourced industry with national regulators and international bodies that move slowly and by consensus. The enforcement gap. The third dimension of the reform challenge is resources. The IRS, as of recent years, has fewer auditors than at any point since the 1970s. The same period has seen a dramatic increase in the complexity of the structures those auditors are trying to analyze. HMRC in the UK faces similar constraints. Tax authorities in developing countries, the countries most harmed by illicit financial flows, have a fraction of the investigative capacity required to trace funds through multi-jurisdictional structures designed specifically to resist tracing. The industry being regulated employs more lawyers, more accountants, and more former regulators than the agencies doing the regulating. This is not a complaint about individual regulators, many of whom are skilled and committed. It is a structural observation about where the resources are and whose interests they serve. The Inflation Reduction Act of 2022 included approximately $80 billion in additional IRS funding, specifically intended to rebuild enforcement capacity, targeting high-income and corporate non-compliance. Before the full implementation of those funds, political opposition had begun to claw them back. The debate about IRS funding is, in this context, not an abstract fiscal argument. It is a direct argument about whether the enforcement architecture will match the complexity of what it is trying to pursue. The money is not hiding. That is the thing that needs to be understood, really understood, before any of this can be approached honestly. It is not in a vault. It is not buried. It is not in a suitcase. It is invested in real estate and bonds and equities and private equity funds. It is generating returns. It is, in many cases, indistinguishable from the capital that surrounds ordinary economic life in pension fund portfolios, in institutional investment vehicles, in the financial infrastructure that most people interact with indirectly every day. It is obscured, hidden not by physical concealment, but by legal architecture, by structures that most governments have chosen, either deliberately or through inaction, or through the slow pressure of an industry with extraordinary resources and a very clear interest in the outcome, to permit. The system exists because it is useful. It is useful to corporations minimizing tax exposure. It is useful to wealthy individuals protecting assets from political risk or inheritance claims or creditors. It is useful to kleptocrats hiding stolen public wealth. It is useful to criminals cleaning money. It does not distinguish between these users. It does not ask. And it costs something real. The Tax Justice Network estimates that governments globally lose approximately $480 billion annually to offshore tax abuse by corporations and wealthy individuals. The IMF has estimated that developing countries lose more in illicit financial flows annually than they receive in foreign aid. These are not the costs of a niche financial product used by a small number of edge case actors. These are the costs of the architecture of the global economy, operating as designed. The money didn't disappear, it simply moved somewhere you weren't allowed to look. If you find this video helpful, kindly like, share, and subscribe.